politics, you need to know the name Tarric Brooker and definitely give him a follow on Twitter. So our next and final speaker, whether it's global or domestic macroeconomic views, will give us a big overview of what's happening in the markets and give you a context of how you can trade with it. So without further ado, over to you, Tarric. Thank you.
Okay. Today's little presentation I put together is Uncharted Waters and the Return of Risk. For the longest time, we've really been sort of playing with training wheel, shall we say. We've had the Fed put. You know, if the market goes down far enough, the Fed will step in, they will save us. They will defend growth because inflation doesn't matter. And for the longest time, that's been true. Because inflation has been low and it's given the Fed and other central banks around the world carte blanche to basically just do what they want. But now, with the advent of inflation, with the way things have changed, we are well and truly in uncharted waters. And there aren't really a lot of historical analogues that can really get to the heart, shall we say, of where we find ourselves now, because you've got, enormous central bank balance sheets. We've got high inflation. We've got high levels of household and corporate debt. All these things, all put together, haven't really happened before. So what I've done here is I've put together all the various different Fed pivots from 1970 to showing the present day. And basically, Fed pivots don't happen quickly. They happen over time, and they usually happen because damage has been done to the US economy. Now, there are exceptions to that. There is the 2018 Fed pivot and obviously the 2020 Fed pivot, but both of those were defined by low levels of US inflation. As you can see, when you have higher levels of inflation, say for example in 1970 or 1974, which is generally the 1970s put forward as the closest historical analogue, it takes a lot more to get the Fed to move. And it's also worth noting that when the Fed did move in 1974, it was seen it's seen with the luxury of hindsight as a mistake because it entrenched inflation for well over a decade to come. So if we look at the way things stand now, we have core inflation of 6.6%. We have an unemployment rate of 3.7%, which is a lot lower than any of the other historical levels. And normally, the Fed likes to wait. They like to wait, somewhere between, 6, 9, 10 months to confirm that the economy has rolled over before they start to pivot and before they start to cut rates. Now, this is Arthur Burns. He is every pivot wanter's hero. He is the guy who cut rates in August of 1974, and he sent stocks rocketing after a very, very challenging time from the oil crisis, and the 1973 recession lasted into 1974, and it was a really, really painful time for risk assets and the economy more broadly. But during that time, what a lot of people don't know about Arthur Burns is that he raised rates by 4% in the middle of a recession in order to kill inflation. That, this man who is seen as the pariah of global central banking went hard at trying to contain inflation. Yet he's remembered as this cautionary tale. He waited for unemployment to rise by almost 1% and for job losses to mount. Now, this is the man that Jerome Powell does not want to emulate. He has said, whether or not it's privately or not, but I have heard from someone who works at the Fed that Powell does not want to be the second coming of Arthur Burns. So does that mean that Powell is going to use the same criteria as that? That he is going to allow the US economy to take a hit, and a big hit, before he actually decides, no, we have beaten inflation? And I think that's a really, really important question, because the internal politics of the Fed and what's going on in Jerome Powell's mind is going to define things a lot more, believe it or not, than a lot of other macroeconomic factors. Yes, there's the key things like core inflation, unemployment, and where the labour market is going. But beyond that, core Fed politics will matter. And so will Jerome Powell's legacy, because he's in there for life now. Once he has been reconfirmed, and he's going to be in there until his term finishes. Now, this is a really important point to remember when looking back and trying to find that touchstone, trying to compare the way things are now with the way things are in the past, trying to find that path forward. Inflation was measured differently back then. This was prepared by the National Bureau of Economic Research, and one of the authors of this paper is actually the former US Treasury Secretary Larry Summers. So suffice to say, it's a fairly sort of authoritative piece of material on this. And there was a point where inflation was worse in the US in 2022 than it was during the peak of the 1974 oil crisis. It's that bad. And I think that is something that the Fed obviously has a much, much greater level of information than obviously the rest of us do, and they've done a lot more research. But I think that really just rams home how bad the issue has got. Now, naturally, this has been distorted by energy prices. It's been distorted by the war in Ukraine. But that's why we're going to get onto core inflation. And that's something that Chris mentioned and why that matters. But before we get there, one of the key things that the Fed wants is the labour market to start putting downward pressure on inflation. Now, who you ask in terms of when that actually happens, at what unemployment rate, it varies wildly. You've got the Congressional Budget Office. They say anything above 4.5% will start putting downward pressure on inflation. PIMCO, for about 5%, Deutsche, 5.5%, and then the San Francisco Fed, well, they reckon it's going to take 6% unemployment to really start pushing down those wage pressures hard and to be a neutral driver of inflation. Ironically, Larry Summers, who's arguably up for Yellen's position if she ends up being shown the door, well, he reckons it's 6.5%. So that could be a really interesting thing if he ends up in the Treasury Secretary's office and he's got Jerome Powell just around the corner. Now, this particular scenario is based on the most bearish mainstream scenario I can find. And this is from the Bank of America. And basically, we're not going to hit the level of neutral unemployment until October. And that's the most bearish scenario I could find. Even if you want to take pre-Lehman levels of job cuts, of economic deterioration, you're still realistically looking at, well, at least July or August before you really start to see the labour market place downward pressure on inflation. And that's based on the most optimistic view of when that will take place. Now, this is inflation in developed markets of all 50 instances since 1970. And basically it shows, well, let's just play with the laser pointer, shall we? This shows where inflation is going according to the current consensus for the Eurozone and for the US. And that shows what basically happens most of the time. It's a very, very hopeful forecast, isn't it? You know, it's this was also put together and shared by our good old Larry Summers, and I think he makes a very good point when he says that inflation's really, really hard to kill once it gets entrenched, because we're past this level now whereby goods inflation and the supply chain issues and all those different things are the driver. That time has passed. Goods inflation now in the last, say, 3 months, in certain prints, it's actually been a draw down on inflation. And so it's now transited and spread into services, which is much, much harder to kill historically. And that's why I put together this. Now, obviously, there's a lot of uncertainty going on. We don't know what's going to happen in terms of the economy. Callum makes some very, very good points about a recession. And yeah, sure, there could be a recession. Things could, the wheels could really come off. But the problem is, what I've done here is I've taken the hit that core inflation took in relative terms from the time the US entered the global financial crisis recession and applied it in relative terms to core inflation as it sits today. And this starts basically last month, because I don't yet have the core inflation figures for October. And basically, as you can see, even if things come down in relative terms by as much as they did during the global financial crisis, when commodity prices got smashed, when you saw things really, really fall off an absolute cliff, well, core inflation is still going to be 4%. And I just think it's worth noting that, this is the worst case scenario. This is if crap really, really hits the fan. But as I mentioned in the panel earlier, there is also the used car factor. So let's give this thing the absolute best chance of getting core inflation under control. Let's give it a GFC, and let's give it a mean reversion in used car prices in real terms. Even if we see used car prices plummet and have a full-on mean reversion to where they were pre-pandemic, core inflation will still be above 3%. It's a hell of a thing. And I think that just really illustrates just how tough core inflation is to kill. Now, I'm not saying that the headline CPI can't come down, because it absolutely can. And if it gets smashed, and if the economy gets smashed, it most certainly will. But you don't want to leave a central bank and everyone else and policymakers are not going to want to leave that just simmering in the background of core inflation of high 2s, low 3s, or even a 4. Because, well, you start throwing stimulus into that, you could potentially have inflation just yo-yo straight back up and be right back where you started. Now this takes us to basically my theory of what I call burnout economics, where you've got one foot on the accelerator, you've got your other foot on the brake, and you've got two different forces basically trying to propel the economy or the market in two completely different directions. So at the moment, so say for example in the UK, you've got this enormous energy subsidy, hundreds of billions of pounds worth, but then by the same token, you've got the Bank of England raising rates by 0.75%, an enormous raise, and you've got them saying that, well, this could be the worst recession the longest recession in a century. So you've got these two forces pushing in completely different directions. Now, why do I think this is going to happen? Well, we can't really have a full-on return to the way things were before, because if they do, things are going to end rather poorly for all these zombie companies. And not only that, a good portion of these are also listed as well. So, you've got this huge number of companies. And this is, I will also note that this doesn't include the rise in debt servicing costs, which has naturally gone through the roof in terms of borrowing costs for the junk bond end of the spectrum. So QE and central bank intervention, they're really, really hard habits to break. You look at Europe for a long time there. They were buying all the net issuance of bonds. Like someone said to me the other day, well, why aren't Greek bonds a risk? Well, because the ECB owns so many of them. Even just the little free float that they've got is still enough to move markets, and that really, I think, speaks volumes. Now, this just goes to show that over the last 8 years, most of the time, the ECB has been buying more than they've been issuing. So that's been a big downward pressure on rates. But it's also worth noting that even as the ECB raise rates, they raise rates the most aggressively that they've ever done. They're still keeping going with the QE in the background. Yes, they're not calling it QE, they're calling it magical other things, which I'll get to later in the slides, but they're still going. You've got these two separate forces pushing in completely different directions. Now, Britain became the poster child for that under the very brief Prime Ministership of Liz Truss. You had her trying to cut taxes for the wealthy, you had her trying to cut taxes in general, you had her trying to give out all sorts of various concessions to try and get the economy moving in a very sort of Thatcher-esque fashion. But then you've got the ECB acting as the only major Western central bank to be selling bonds. They're actually doing full-on proper quantitative tightening. Now, all the other various central banks, they're also doing QT, but they're not selling bonds. They're just allowing the ones that they already have to mature and roll off the balance sheet. And in Europe, same thing. You've got the ECB raising interest rates, more rate rises to come. Madame Lagarde has been very, very clear in that. But then you've also got them doing the transmission protection instrument, which is also known as the magical fairy dust that they will sprinkle if Italian bonds get into trouble, because they need a mechanism to basically keep the spread between German bonds and, say, Greek bonds or Italian bonds and other bonds in the periphery where the economies are weaker in line, so they don't have this enormous blowout in borrowing costs. So even though they're tightening, they're not really stopping with the other elements of loose monetary policy. Now, what I think we're going to see here is we're not going to see the good old days of just the fire hose of liquidity, of Jerome Powell going on national television and telling everyone that we're going to see everyone will be made whole, everyone's going to get their money back, everything's going to be fantastic, everything is going to be a lot more targeted. And there's a few reasons for that I'll get to in a minute, but I think that this puts it into a very nice perspective. In the first month of the recent Bank of England support measures that they introduced in order to stop the bond market from, well, blowing up pension funds, they spent £19 billion on buying bonds. That was a hell of a lot less than the $65 billion that they offered to buy, but it just goes to show how the market's reaction just goes, oh, well, some form of QE, we better buy. But then you look at the first month of QE in 2020, £58 billion, and that was just the beginning of this enormous run-up in the Bank of England balance sheet. So going forward, unless inflation comes down sufficiently, the support from central banks and the trading environment is going to be completely different, because they're not going to be able to just throw that fire hose of liquidity at the market and just have the market roar magically higher as it did in 2020 and as it did in 2018 and as it has in many times, since 2008. Now, I think the perfect example of this reaction from the market and why, in a lot of ways, support doesn't need to be as large as it was in 2020 or following the financial crisis is because when the Fed waves their magic wand, people take notice. They go, okay, what's going on? What are people doing? How are they reacting? And then the Fed will act accordingly. The Fed pledged to buy $250 billion worth of bonds, worth of junk bonds, corporate bonds, and through ETFs. And the market turned around and just went, great. Jerome Powell told us that we're going to be made whole. So, this is going to be a fantastic trade. Yet, so the market did Jerome Powell's job for him. It turned around, it had a very, sort of Pavlov's dog reaction. The Fed rang the bell, the dog started salivating, and the market bought the bonds. So they only had to buy a fraction of the bonds, $13.7 billion worth, compared with the 250 that they promised, because it did the job all on its own. And that's exactly what happened with the UK bond market. They pledged to buy £65 billion worth of bonds. They bought $19 billion, yet it was more than enough to put downward pressure on UK bond yields. Admittedly, part of that is probably Liz Truss, being shown the door. Now, at the moment, we are seeing a lot of talk. This big commitment from central banks that we are going to hold the course, that we are going to keep going until inflation is done. Jerome Powell doesn't want to be Arthur Burns, and, well, Christine Lagarde doesn't want to blow up the EU economy. And I think that's a key little quote there from Jerome Powell's November rates presser, which really scared the crap out of the market on the day. Risk management is key here. If we were to over-tighten, we could use our tools to support the economy later on. But if we failed to tighten enough, inflation would become entrenched, and that would be a much bigger problem. Those words were recently echoed by Bill Evans at Westpac, talking about the RBA's approach to rates, and basically that he thinks, and Westpac thinks, that it should be more aggressive. But translated from central banker speak into normal human language, that basically means we know there's going to be a recession. We know that there will be, but it doesn't matter. We're going to keep tightening because that's what we've always done. And they're going to keep tightening until something breaks, because that's usually what the Fed does. And looking at the various data points, looking at job openings, looking at all these various things, if you look at the things that the Fed look at, I'm not seeing a whole lot that is going to give them an excuse to stop raising rates to cut rates anytime soon, to be able to do that much prophesied pivot. And even, Madame Lagarde, a mild recession would not be enough to tame inflation on its own. So even though Lagarde is obviously very aware of the fact that there could be a recession and the fact that there probably will be in the Eurozone, well, she doesn't really care. She knows that she needs to keep the hammer down on inflation. She can't walk away from this, as much as she may want to. Now, I sort of see this ending in an inflationary yo-yo. Basically, that you end up with them doing enough to eventually get inflation under control, whether it's core inflation, whether it's headline inflation, probably headline, let's be honest. I don't think they've got the balls to really smash down core inflation for long enough, but I could be wrong. And this is all of course occurring within a backdrop of politicians getting antsy, shall we say. We've got, the likes of Democrat Senator Elizabeth Warren writing to the Fed, telling them to please stop. And as the economy continues to deteriorate, that criticism and that interference is only going to become more intense. And when you do obviously hit a recession, then you're going to start to see more calls from the corporate world. You're going to start to see more pressure from political donors. So that's why I think that we are going to see this pushback, shall we say, against the Fed, against other central banks, and eventually one will break off. You will see one, do the pivot. Now, I think that one of the interesting things going forward is who's going to be the first. If it's the Fed, great. Then you'll see a synchronized pivot all over the world, because ultimately Jerome Powell is driving the interest rate bus. But if it's the ECB, or if it's the Bank of England, well, that creates some very interesting sort of scenarios. Do you see further weakness of those currencies? Do you see further weakness in those economies as the currencies weaken and inflation rises? There are potential opportunities there to be traded. Ultimately, high levels of core inflation in general, I should say, are going to be the defining factor of how this plays out. Because if inflation is still left simmering, just left alone, and then someone decides that we are going to do more stimulus, that we're going to throw money at the economy, Joe Biden gets together with, the rest of Congress and just starts throwing cash at the US economy again, we still have the same problems that we have today. We still have China with COVID-0. We still have the war in Ukraine, potentially, and obviously as well, the issues with OPEC trying to put upward pressure on oil to keep it, some say between $90 and $100 a barrel. So with all those various factors combined, the risk is that perhaps inflation does go away for a time, but then it comes right back. And that's all I've got for you tonight, folks. I won't keep going any longer. You've been a terrific audience, and thank you.